Welcome to the first lesson of our technical analysis series. In this lesson, we'll delve into an introduction to candlestick charts. Our course format involves a straightforward lecture style without elaborate editing or animations. The lesson outline consists of a disclaimer, a brief overview of technical analysis, candlestick anatomy, time frames, patterns, an essential tip, and concluding thoughts. Before we begin, I want to emphasize that none of the content, whether on my Twitter, Telegram, or any other platform, constitutes financial advice. I am not a qualified financial advisor, and all trading is at your own risk. This video and the entire series are for entertainment purposes only. Technical analysis is a tool for making probabilistic forecasts about future price movements based on historical price data. It's crucial to grasp the probabilistic nature of this approach, as we work with odds and probabilities rather than seeking definitive facts from price charts. The second key purpose of technical analysis is to identify risk-defined entry and exit points for speculative trading. Even if you have a fundamental bias towards a particular asset, technical analysis can help pinpoint advantageous risk-reward setups for long or short positions. Remember, technical analysis doesn't grant the power to predict future prices outright. Instead, it's a humble science that aids in risk management. Understanding this perspective is essential. As we proceed, we'll explore how technical analysis can enhance your trading strategies. Stay tuned for the rest of the lesson. Technical analysis is a tool for making probabilistic forecasts about future price behavior based on historical price data. It's not about deriving knowledge or facts from the price chart, but rather working with probabilities, odds, and chances. Its primary purpose is to identify risk-defined entries and exits for traders, even those with fundamental biases. However, it's important to recognize that technical analysis doesn't provide a way to definitively predict future prices. Instead, it's a humble science focused on managing risk. This perspective will be further explored in the next lesson on risk management. Candlestick charts represent one version of a price chart, among various options available on platforms like TradingView. Japanese candlesticks are commonly used and will be our focus. These candlesticks consist of three main parts: candlestick color, candle body, and wicks. The candlestick color indicates price movement. A red or bearish candle signifies that the closing price was lower than the opening price within a specific time frame. Conversely, a green or bullish candle indicates the closing price was higher than the opening price. Moving to the candle body, in a red candle, the upper body represents the opening price, and the lower body represents the closing price. For a green candle, this relationship flips: the upper body is the closing price, and the lower body is the opening price. Lastly, the wicks are the extended lines above and below the candle body. The upper wick represents the highest price reached, and the lower wick represents the lowest price within the given time frame. This breakdown simplifies the anatomy of Japanese candlesticks. Candlestick analysis becomes more insightful when utilizing the open, high, low, close, OHLC data. This acronym refers to the key price points of a single candlestick. Hovering over a candlestick reveals its OHLC values, which offer crucial information for tracking various price aspects. For instance, the open and close of the week, day, or specific swing points. Using TradingView as an example, hovering over a candlestick on the daily chart displays its OHLC data. Yesterday's candle, for instance, opened at 63.22, reached a high of 6,530, hit a low of 6,321.5, and closed at 6,487.5. This data enables traders to set levels like the day's high or low for reference while trading intraday. Additionally, understanding OHLC aids in marking significant price zones. Mapping out the weekly open, for example, at 6,240, helps traders identify critical areas without repeatedly switching time frames. Although strategies might vary, grasping OHLC data is pivotal for effective candlestick analysis. Time frames play a crucial role in candlestick analysis. The chosen time frame determines how long a single candle represents. For instance, a 15-minute chart has candles reflecting 15 minutes of trading. This also contextualizes the open, high, low, close, OHLC data. On an hourly chart, one candle stands for an hour of trading, allowing us to track OHLC for that time frame. When examining candles on a specific time frame, such as the hourly chart, each candle encompasses 1 hour of trading. The OHLC values give us a clear picture of price movements within that hour. Notably, higher timeframe candles are composed of lower timeframe candles. For instance, an hourly candle consists of 4 15-minute candles. However, it's important to remember that candle closes hold significance. Waiting for a candle to close before making trading decisions is advised, especially on higher time frames like daily and weekly. Rapid changes in the final moments before a close can alter the candle's appearance, impacting trading strategies. Therefore, beginners should focus on a couple of higher time frames to avoid noise. A combination of daily and hourly time frames, for instance, can provide a comprehensive view for effective analysis. Candlestick patterns can be misleading for beginner traders who rely solely on them without considering context and time frames. I personally focus on swing highs, swing lows, doji, shooting star, hammer, engulfing candles, and tweezers. However, it's crucial not to become obsessed with these patterns. Instead, apply them within a nuanced approach. Avoid blindly trading every pattern you've memorized from cheat sheets. To effectively use candlestick patterns, look for clear patterns on higher time frames where they make sense. Reversal patterns are more meaningful within strong trends, either upward or downward. A trend is a discernible direction in the market, marked by higher highs and higher lows for an uptrend, and lower highs and lower lows for a downtrend. Beware of online systems that promise easy profits based solely on candlestick patterns. Remember, candlestick patterns are tools best employed by knowledgeable traders who understand the nuance and context of the market. Don't fall for shortcuts. Success requires a well-rounded strategy. The color scheme will remain unchanged. 2 crucial tips can save you money in the long run. First, focus on higher time frames, like the hourly and daily, instead of lower ones like 1 minute or 5 minutes. Second, remember to zoom out. New traders often get caught up in minute-to-minute movements. Adhering to these tips will provide a broader perspective and help you make better trading decisions. In conclusion, well done on completing the first lesson. Learning to read candlestick charts intuitively is vital. Spend time studying charts until it becomes second nature. This comes with screen time. Familiarize yourself with the open, high, low, close tool, especially for marking key levels and swing points. Regarding time frames, avoid low time frame noise. Study and observe a couple of higher time frames that work for you. When it comes to candlestick patterns, context matters. Focus on reversal patterns within clear trends. Don't chase patterns everywhere, wait for suitable setups. Lastly, use higher time frames and zoom out to gain a broader perspective. As a beginner, it's tempting to trade every move on lower time frames, but higher time frames and zooming out will develop your understanding of price. Thanks for watching, and enjoy the upcoming lessons.